Now, the Finance Minister, Nirmala Sitharaman, has announced that short-term capital gains tax has been increased. She has announced this when she rose in Parliament, and the increase is to 20%. Earlier, it was 15%, and this is for specified financial assets. And yes, long-term capital gains, that tax has gone up. Now it's 12.5% for the financial year FY25. We are going to listen in first to the Finance Minister and discuss this with the tax expert joining us from Deloitte. But listen in first to what the Finance Minister has said about capital gains tax.
Capital gains taxation is also proposed to be hugely simplified. Short-term gains on certain financial assets shall henceforth attract a tax rate of 20%, while that on all other financial assets and all non-financial assets shall continue to attract the applicable tax rate. Long-term gains on all financial and non-financial assets, on the other hand, will attract a tax rate of 12.5%. For the benefit of the lower and the middle income classes, I propose to increase the limit of exemption of capital gains on certain financial assets to 1.25 lakh rupees per year.
Well, that's what we've got from the Finance Minister today. Let's discuss the implications, both on personal taxation and the implications that come through as far as these announcements on capital gains in particular are concerned. And for that, Gokul Chaudhri is joining us. He's President for Tax at Deloitte India. Mr. Chaudhri, a pleasure having you on ET Now. Tell us about the effective rates. How does that picture change on capital gains first?
So the capital gains rationalization had been in the works for a while. And, we heard about it in the previous budget. We heard it about in various public announcements for a period of time from the Finance Minister. So therefore, in some ways, this matter had been there for a period of time where the Finance Minister believed that there were just too many periods of holding, just too many rates, too many categories of assets, and too many categories of various taxpayers who are getting at different points of time taxed away in a varying way. So I think the rationalization of this was in the works, and therefore, to some extent, it arrived today. I think the first big piece is that they have rationalized the holding period into long-term and short-term on just two thresholds. One is 12 months for listed securities, 24 months for all other assets. So I think that's the first big change that they've done from the simplification perspective. Now, what that will do is certain asset categories will become better positioned than before, and others will be hurt a little slightly. For example, where will the help be? Well, when you look at bonds, you look at debentures, you look at gold, the holding period, which was earlier 36 months, has come down to 24 months. And then, of course, the unit holders for REITs and InvITs will now be on par or long-term capital gains with listed shares. So I think there is some amount of rationalization which has been done there. The second thing which they've done is they looked at the rate, and they've come down to the following. They've said that the long-term capital gains rate, which was earlier 10%, gets reset to 12.5 for all asset classes. So earlier, there were a bunch of assets which were taxed at 20%. There were a bunch which were at 10%. So really, at 12.5%, there has been some listed securities, which will, of course, be adversely impacted, but there will be others which are unlisted, which will become better positioned. So, for example, if we look at the long-term capital gains rate for residents, that's come down from 20 to 12, but the indexation has gone away. So therefore, if you had, for example, a property which you sold, earlier you would have 20% indexation, now you've got 12.5% flat on the capital gains rate. So the rate rationalization is going to be impacting.
You're calling it rate rationalization, Mr. Chaudhri, but as far as the Aam Aadmi is concerned, the middle class, in terms of the investment avenues, and there was talk about bringing some sense of parity among asset classes, there was a sense of belief that investments in equities was drawing in that much more attention because the government wanted that much more to go through that. But when you look at the avenues for investments for the middle class right now, and the way the tax structures are developing as it stands, because there is clearly a trajectory that you pointed out as well. How do you think that is looking? Are there that many more avenues for investors to park their money and to get more, even if you consider the higher taxes today?
Well, I think that the response which came in, I think, from the finance secretary post the budget speech was as follows. They said that between 62 to 83% of the entire capital gains that's being paid is really being paid by the rich. And therefore, a large part of the capital gains tax burden, which they are seeking to increase, is going to be falling on the rich because they're the ones comprising 80% of the payments today, and they will be paying slightly higher than what they were paying before. So therefore, in some ways, the middle classes were not being the ones which were being liable to the capital gains tax relief earlier. And hence, the expectation is that they will not be adversely affected by coming into the capital markets today because they were never really enjoying the benefit of being in the equity markets for a period of time.
Does that need to change, Mr. Chaudhry? And what do you think of the government's push? Do you think that the needle needed to move a little bit more when it came to tax slabs under the new tax regime, the income tax regime? Do you think at this point in time there is enough incentive for taxpayers to kind of go in for that compliance and widen the tax net as well? Because that's one way to ensure that the current crop of taxpayers get some kind of rationalization in the amount of taxes that they are paying.
So yes, you're right. The government brought in the new personal tax regime. The finance minister did speak about the fact that nearly two-thirds of the people have migrated to the regime, but obviously it is not having the same amount of uptake as what we would have thought it would have had the slabs been better positioned and the standard deduction, of course, a little more incentivized. The finance minister did some amount of movement on the needle on both accounts. From 50,000 of standard deduction, they moved it to 75. I think it would have been better if it had been closer to a lakh of rupees, if not a lakh of rupees of standard deduction coming in there. And similarly, on the slab rates, I think the government moved the needle by a lakh of rupees on the slab rates. I think it would have been better if they had moved it by 2 lakhs so that the initial slabs of 3 lakhs and 6 lakhs would have actually moved to 5 and 7 respectively. So they should have moved it by 2 lakhs to be able to get the compatibility, whereas the loss of or the enhanced taxes on account of loss of exemptions could have been materially made up by doing both these things, a higher rate of standard deduction and trying to bring the starting slab rate for the personal taxes to about 5 lakhs instead of current 3 lakhs.
Mr. Chaudhry, whether you talk about the finance ministry or you talk about SEBI, there have been literally alarming signs when you look at the attractiveness that investors find in F&O trades. Do you think in this budget we've seen enough to disincentivize that?
Well, they brought in some amount of tax on it. Whether that's adequate or inadequate, I guess we will get to see in the coming days. But I think that there is certainly a recognition that the government has, in a world where we would be representing the taxpayers, I would actually have said, if the FNO trades were taxed a little more and the capital gains on listed securities were a little less, it would have been a better outcome. But that's a perspective from this side of the table. Maybe the government had different views.
Also, Mr. Chaudhry, when it comes to spurring consumption, especially when it comes to the rural economy, that was an important ask. As far as the push from the government side is concerned, do you think this budget has delivered on that count? How much was required and how much do you think this budget will deliver to spur that much more consumption?
Well, I think the way the finance minister opened her conversations in the budget, she really put the emphasis firstly on jobs. And a lot of the job creation was again a thrust that the government did push for. So I think they came up with some innovative ideas in relation to job creation, specifically the incentive that they're going to give to the manufacturing enterprises to be able to create jobs. And the government does give some amount of support for those job creation. They also brought in the fact that they would incentivize 500 companies to enhance the skilling through an internship program. I think the emphasis largely was to try and see whether they can create more aspirational jobs in the services sector and in the manufacturing sector. And I think it will be interesting to see as to how that experiment goes and if they are able to create jobs in those segments.
In fact, that was going to be my question about the government's push towards generating employment and skilling. That's been an important piece, and yes, you've addressed that. Mr. Chaudhri, that's where we're leaving it. Thank you very much for joining us with your perspective on the Union Budget 2024, an important piece, the seventh consecutive budget that the Finance Minister has presented, and indeed the first one for Modi 3.0. So on all counts, this remains an important piece, and the kind of feedback that we are getting as well, a lot of it is sounding rather positive. Mr. Chaudhri, thanks indeed for joining us this evening. Meanwhile, waiting in the wings is Swaminathan Aiyar, our consulting editor here at ET Now, and an economist who everyone wants to listen in to by way of views on the budget for sure. Mr. Aiyar, it's always a pleasure getting you here on ET Now. Tell us, what do you make of the kind of tax regime changes that have been announced in the budget this time? We were talking about the long-term and short-term capital gains taxes. What do you make of them?
Well, these tax changes are going to bring the smiles to the faces, I think, of lots of investors. The biggest thing that has happened is the cut in long-term capital gain tax to 12.5%. So lots of people who are in the market will be extremely happy, and that will be a fundamental push. The short-term gains on some assets have been raised from 15 to 20, which people may not like. Again, the dividend, the buyback of shares was being used as a way of avoiding dividend tax. Now the buyback thing is going to be used and taxed as a dividend. And some people may say, well, I tried to escape on that. I'm not going to be escape anymore. The income tax slabs have been, the exemption rates have been raised for all those slabs. And given inflation in the last 5 years, there was a case for doing it, and it has been done. The middle class will be happy with it. It will think that this is a great thing. Over and above that, I would say the overall tax structure needs to be brought in alignment with the global thing. This the cut in the capital gains tax to 12.5%, it is well below, for instance, the 20% in the USA. So while the market will be happy with it, Rahul Gandhi and the others will say, why are you giving so many concessions to people who are already so rich? And I think this would have to be explained. At the same time, I would say that the attempt to bring smiles on the people of the middle class has also now become a very, very big investor in the market. It is not only rich people. And from that point of view, you know, people who have been investing in mutual funds, every now and then, they will be happy with this reduction in the long-term capital gains. So on balance, these are things that are not easily done by a budget that is in some financial consolidation mode. It is utterly remarkable that they managed to cut these taxes even as they have reduced the deficit by so much.
Mr. Aiyar, I haven't seen you as exuberant about a budget in recent times as I am seeing you right now. But also address for us this increase that we are seeing in STT on F&O transactions. How do you think that's going to play out?
I think the increase in STT, the aim is to try and get back some of the money that is being lost on long-term capital gains. The amount of money they will get from this increase in STT is very substantial. It will therefore, in some sense, produce a kind of budgetary balance. What they are doing is they are taxing volume of shares instead of the capital gain. A pure economist will say this is not a good policy. It is better to tax the income rather than tax transactions, which have negative results in general. But that is what they have decided to do. I do not know whether the totality of the market, therefore, will be that happy with these cuts. Certainly the middle class will be happy because it doesn't indulge in transactions every day. But the big traders, may find that, you know, they are more unhappy with the increase in STT than the cut in the long-term capital gains.
Yes, in fact, I was just talking about this with my earlier guest as well, how the idea is to be able to broaden the tax net, as it were, but we'll see exactly how that works. Mr. Aiyar, what about the fiscal deficit by way of the discipline that the government needed to follow? What do you make of the government's plan?
I will say that, it's not so much what the finance minister has done, but what the economy has done. Because we had 8% to 8.2% GDP growth, we had good collections from GST, and above all, the collections from personal income tax really boomed. So on the one hand, we had the boom in the tax revenue. On the other hand, we had a record dividend payout by the RBI, 2.1 lakh crores. The combination of these factors has given Nirmala Sitharaman so much money. On the one hand, she has managed to do massive investment in infrastructure. 3.4% of GDP is very good. She has combined that with reducing the fiscal deficit from effectively 5.8% last year all the way down to 4.9%. This kind of consolidation, believe me, is very rare. Sometimes countries under IMF discipline manage to reduce it by 1%. For Nirmala Sitharaman to do this in these conditions is an extremely good thing. There is long-term stability. There are no revenues. There are no freebies. So, given this overall thing, all that you can say is that it has been possible to do the macroeconomic conditions which are far above market expectations. The market, I don't think, would have expected this. Certainly, a few years ago, when Nirmala Sitharaman said, I will bring it back below 4.5% by 25-26, I was a skeptic, and I will say right now, I have to eat crow. She is going to be able to do it. Well done.
So yes, like I was saying, Mr. Aiyar, this sounds very laudatory for the finance minister. She'd be very happy if she was listening in right now, coming as it is from you. But overall, if you were to look at the budget this time, when you look at the kind of hits which you're pointing out are many, there would be some misses as well. Some have said that when you talk about the economic growth, the long-term concepts, those haven't come through in the budget. But if you were to tell us what you think are the hits and misses, tell us which would those be?
There are different ways of looking at a budget. A budget per se, just presenting, revenue and spending is not a very exciting thing. Changes in some of the tax rates are okay. But for instance, some of the most important reforms required, like, the GST rates are all over the place. Some rates are too high, some are too low. There are too many rates. All this needs to be reformed, but it can't be done in the budget anymore. Excise duty is no longer done by the central government in the budget. It is done by the GST Council. So that particular thing remains to be done. It is outside. You say, as for what else could have been done in the budget, Mr. Manmohan Singh used to announce various major policy changes, and that is why people began to pay attention, that the budget is not just presentation of the government's accounts. It is also an occasion for major policy changes. This particular budget, in fact, Sitharaman in the last 5 years, budgets have not been used for major policy changes. What are the big policy things? You will find people still complain that land acquisition is a huge problem. The government tried with it in Modi's first term. It remains a problem and nothing has been done about that. Labor, the flexibility, additional things, it remains a major problem. It has not been fixed. And in any case, there again, the state should have to come. Pollution, India has 6 of the world's 10 most polluted cities. There is really nothing in the budget whatsoever. This is an urgent thing because dirty air and dirty water is killing people. And finally, I would say the police judicial system, everybody complains about, you needed to improve that. I do not find larger outlays for this or even a promise to fill all the vacant positions there are. Again, much of this is in the realm of the state governments. There's a limited amount the central government. But I would have been happy if there were major reforms in these 4 areas where reforms are badly needed. I didn't see any sign of that. And I would have been happier if they had dealt with these major problems that remain in the larger economy.
You're absolutely right, Mr. Mr. Aiyar, land reforms, labor reforms, when you look at judicial reforms and indeed in addressing climate change issues, leave aside, of course, what investments or capex is going towards green energy, we'll have to wait and watch more budgets to come through, and perhaps there could be more in times to come when it comes to policy and reforms. Mr. Aiyar, such a pleasure talking to you as always. Thanks very much for joining us on ET Now with your perspective on this budget 2024.
If you like this video, then like, share and subscribe to ET Now.